At terminal velocity, a super heavy booster is a multi-million-dollar asset. But when an erratic engine startup prevents the required catch mechanisms from engaging, the flight ends in a hard, uncontrolled splashdown in the Gulf of Mexico. Despite highly public anomalies like this, the company manufacturing these launch vehicles currently controls approximately 87% of all Western commercial orbital missions. And in June 2026, they are taking that dominance public at a valuation of $1.75 trillion. But reading the appendices of their 400-page S1 prospectus reveals a stark mathematical reality. In the first 90 days of 2026 alone, the company reported a net loss of $4.28 billion. That equates to $47 million disappearing every single day. Institutional investors are aggressively pursuing allocation anyway. The most cautious sovereign wealth and pension managers are looking past the immediate solvency metrics, because they are pricing this IPO on the belief that SpaceX will control the primary logistical routes to orbit and the high-altitude data centers that power them. The financial oxygen keeping that ambition alive comes down to this specific consumer hardware. Starlink generated $11.39 billion in 2025, providing 61% of SpaceX's total corporate revenue. This chart compares profit margins across the telecommunications sector. Traditional network providers operate at a 30 to 40% EBITDA margin. Starlink nearly doubles them, operating at approximately 63%. SpaceX uses this cross-subsidy architecture. The billions in profit are routed immediately to fund two highly speculative capital furnaces, Starship and xAI. To build this profit engine, the company executed a deliberate market saturation strategy. They cut average user costs from $99 down to $81, scaling past 10 million paid subscribers before any competitor could establish a meaningful base. Once users had no comparable alternative, SpaceX raised prices in May 2026. Without that captive subscriber base compounding quarter over quarter, the rest of the company's projects immediately run out of operational runway. That runway is getting significantly shorter. SpaceX completed an all-stock acquisition of xAI, backed by a commitment from Anthropic to pay $1.25 billion per month through 2029 for AI compute infrastructure stationed in orbit. But getting that heavy AI infrastructure and the next generation of Starlink satellites into orbit presents a strict physical bottleneck. The legacy Falcon 9 vehicle is too small to efficiently deploy these heavier assets at scale. This diagram maps the exact dependency chain Wall Street is currently modeling. If the heavy-lift vehicle cannot deploy the V3 satellites, the existing constellation degrades. Service drops and subscriber churn increases, forcing the entire corporate enterprise to rely on outside capital raises rather than its own internal profits. Add to that NASA's $2.9 billion Artemis contract to return humans to the lunar surface. That specific mission architecture demands a massive payload capacity that only this unproven heavy-lift system can theoretically provide. Every high-margin future enterprise, from military logistics to orbital AI compute, rests on the operational success of a single rocket that does not yet reliably fly. Standing 120 meters tall, Starship generates more thrust than any vehicle ever flown. But to make this massive structure a viable business model, SpaceX engineers have to solve three independent physics problems at the exact same time. This schematic illustrates three concurrent physics problems. First, at 1400 degrees, a cracked tile lets plasma breach the hole. Second, orbital refueling. Storing sub-zero propellants under solar radiation causes rapid boil-off before transfer. Third, this skyscraper-tall rocket risks toppling on uneven lunar terrain. This creates an organizational complexity trap. The lunar mission requires the heat shield, the orbital refueling, and the landing stability to function flawlessly in tandem. Attempting to solve all three sequentially takes too long. Attempting to solve them in parallel multiplies the risk of failure. SpaceX approaches these hurdles using rapid, destructive iteration. They launch, observe the failure, and rebuild. But this hardware-first philosophy collides directly with a federal regulatory framework built to ensure civilian safety. Every heavy-lift launch requires massive airspace closures. The FAA estimates SpaceX's trajectories currently disrupt over 13,000 commercial flights annually. When an anomaly triggers a mandatory federal investigation, operations are grounded for months. severely restricting the company's iteration speed. Then there is the executive structure. Institutional risk managers discount public companies that lack board independence. The S1 grants majority voting control to an individual actively managing multiple distinct corporations, creating a highly quantifiable keyman risk. This chart models the hard mathematical reality of the upcoming IPO. Divide the $75 billion raise by the current accelerating burn rate of $17 billion a year, and SpaceX buys approximately 4.4 years of operational runway. The strict quarterly profit demands of public markets will soon require immediate returns from a development timeline that requires a decade of patient, uninterrupted engineering. While analysts debate the financial metrics, SpaceX is executing a preemptive capacity expansion. The low Earth orbit environment is a finite physical resource, and SpaceX is occupying the most valuable orbital real estate before any competitor can match their pace. Through the Starshield military variant, multiple allied defense forces are now operationally dependent on SpaceX for frontline communications. The company is actively embedding itself into the hardware of global security. Allied militaries are now operationally dependent, making any change in provider a risk to mission continuity, rather than a simple procurement decision. The primary challenger to this monopoly is a Chinese space program executing a reusability pipeline with the full backing of a command economy. They have no quarterly earnings requirements, no FAA environmental reviews, and no IPO scrutiny. The Pentagon has formally noted the strategic vulnerability of relying entirely on a single corporate entity, especially one governed by an executive capable of making unilateral decisions regarding critical defense communications. If the financial gravity of a $17 billion annual burn rate eventually forces SpaceX to stumble, Western governments will have to choose between bailing out a private monopoly or watching a foreign superpower claim the dominant share of orbital launch capacity and global satellite coverage.